We shall commence this module by discussing balance of payments, which is one of the most important statistical statement for any country. The balance of payment is a systematic record of all economic transactions between the residents of a given country and the rest of the world in an accounting period. The system of balance of payment accounting, some of the concepts and terminologies used in the balance of payment expressions and interpretation of the balance of payment categories are of utmost importance to the students of international economics. After studying this module, you shall be able to understand the meaning and various concepts and components of balance of payments. Explain categories of accounts under balance of payments. Elaborate the difference between balance of trade and balance of payments. Explain the concepts of balance of payment settlement and adjustment. Now we will discuss the definition and concepts of balance of payments. Accounting method and format. The balance of payment transactions include all the foreign receipts of and payments by a country during a given year. The receipts include all the earnings and borrowings of foreign exchange, and they are recorded as credit items. The payments include all the spending and lending of foreign exchange, and they are recorded as debit items. As such, all the foreign receipts are financial inflows and all the foreign payments are financial outflows in an year. In the purely accounting or bookkeeping sense, the balance of payments must always balance, because the balance of payment is a schedule of debit and credit transactions which must necessarily be equal. While the equality of debits and credit, that is accounting balance, is inevitable, it does not necessarily follow that the balance of payment equilibrium is guaranteed. Accounting balance is consistent with balance of payment equilibrium, that is deficits and surpluses in the balance of payment. The balance of payment statement basically includes 6 major accounts, which are goods account, service account, unilateral transfer account, long-term capital account, short-term capital account, and international liquidity account. The goods account. The goods account includes the value of merchandise export and the value of merchandise imports. These items of foreign exchange earnings and spending are called as visible items in the balance of payments. If the receipts from exports of goods happens to be equal to the payments of imports of goods, we describe the situation as one of the zero goods balance. Otherwise, there would be either a positive or a negative goods balance depending on whether we have receipts exceeding payments, that is positive, or the payments exceeding receipts, that is negative. Positive goods balance is regarded as favorable for a country and negative goods balance is regarded as unfavorable. The service account. Just as a country exports goods and imports goods, they may be final consumer goods, intermediate goods, goods or raw material. A country also exports and imports what are called as services. The services account record all the service exported and imported by a country in a year. Unlike goods, which are tangible or visible, services are intangible. Accordingly, service transactions are regarded as invisible items in the balance of payments. They are visible in the sense that service receipts and the payments are not recorded at the port of entry or exist as is the case with the merchandise imports and exports receipts. Except for this, there is no meaningful difference between goods and service receipts and payments. Both constitute earnings or spending of foreign exchange as opposed to borrowings and lendings of foreign exchange. Goods and services accounts together constitute the largest and economically the most significant component in the balance of payment of any country. The services transaction include various forms. They basically include transportation, banking and insurance receipts and payment from and to the foreign countries. They also include tourism, travel services and tourist purchases of goods and services received from foreign visitors to home country and paid out in foreign countries by home country citizens. They include expenses of students studying abroad and the receipts from foreign students studying in the home country. They include expenses of diplomatic and military personnel stationed overseas, as well as the receipts from similar personnel from overseas who are stationed in the home country. And they include interest profit, dividends and royalties received from foreign countries and paid to the foreign countries. These items are generally termed as investment income or expenditure, or receipts and payments arising out of what are called as capital services. Service balance is a sum of all invisible service receipts and payments. A positive sum is regarded as favorable to a country and a negative sum is considered as unfavorable. Unilateral transfer account. The third account in the balance of payment schedule is the unilateral transfer account, which includes all gifts, grants and reparations, receipts and payments to foreign countries. It consists of two types of transfers, that is government transfers and private transfers. Foreign economic aid or assistance and foreign military aid or assistance received by the home country's government or given by the home country's government to foreign country's government constitutes government transfers. Private transfers, on the other hand, are the funds received from and remitted to foreign countries person to person basis. An Indian, for example, settled in US remitting $1,000 a month to his parents in India is a unilateral private transfer inflow item in Indian balance of payment and a debit in US balance of payments. Unilateral transfer payments and receipts are also called unrequited transfers because, as the name suggests itself, the flow is only in one direction with no automatic reverse flow in other direction. There is no repayment obligation attached to these transfers because they are not borrowing and lending but gifts and grants exchanged between government and people in one country with the government and people in the rest of the world. Long-term capital account. It includes the amount of capital that has moved into or out of the country in a year. Any capital that has moved in or out of the country for a period of 1 year or more is regarded as long-term capital movement. The long-term capital includes private direct investment, private portfolio investment, that is investment done in securities, bonds, shares, etc., and government loans given to a foreign government, that is debit, and received from foreign governments, again a debit. Short-term capital account. The bank deposits and other short-term payments and credit arrangements fall into this category. Short-term capital items fall due on demand or in less than 1 year as opposed to long-term capital flows which have maturity after 1 year or thereafter. The vast majority of short-term capital transactions basically represents bank transfers that finance trade and commerce. It is also interesting to note that it is often hard to keep track of all the short-term capital movements in and out of the country. They can at best be rough estimates. Indeed, in some countries, a separate category of short-term capital account does not exist. These transactions are simply included in an account under the general term errors and omissions, including short-term capital account. In some countries, short-term capital transactions are included in the unrecorded transactions as a separate balance of payment account in its own right. This unrecorded transaction account for errors and omissions accounts included statistical and recorded errors, illegal and secret capital movement, and imperfect estimation procedure. International liquidity account. International liquidity account simply records the net changes in foreign reserves. Essentially, this account lists internationally acceptable means of settling international obligation. Debit entry in the international liquidity account shows that there is a surplus in the balance of payment of the country, and that year-end credit entry in the international liquidity account shows that the country had a deficit in the balance of payments of that magnitude in that particular year. Balance of trade. Balance of trade may be defined as the difference between the value of goods and services sold to foreigners by residents and the firms of the home country and the value of goods and services purchased by them from foreigners. In other words, the difference between the value of goods and services exported and imported by a country is the measure of balance of trade. If the two sums, the value of exports of goods and services and value of goods and services imported, are exactly equal to each other, we say that there is balance of trade equilibrium. If the value of exports of goods and services exceeds the imports, we say balance of trade is surplus. And if the value of imports of goods and services are more than the value of exports of goods and services, we call balance of trade is in deficit. Balance of payment on current account. This is a broader concept than the concept of balance of trade. Balance of payments on current account includes a sum of three balances, viz. Merchandise balance, service balance and the unilateral transfer balance. In other words, it comprises of trade balance in Meade sense and transfer balance. The balance of payment on current account is also referred as net foreign investment because the sum represent the contribution of foreign trade to GNP. It is also worth remembering that balance of payment on current account covers all the receipts on the current account earnings and all the payments arising out of spending. There is no reverse flow entailed in the balance of payment account transactions. Balance of payment on capital account. All the transactions involving inward and outward movement of capital and investment, be it long term and short term, direct, portfolio, private or government, individual or institutional, etc., are included in the capital account of balance of payments. It is useful to understand the broad trends and implications of capital account transactions in the balance of payment of countries of the world. Developed countries are the exporters of capital and investment, and less developed countries are the net borrowers of foreign capital and investment. From that, it follows that the developed countries could experience deficit in their balance of payment capital accounts, and the developing countries would enjoy capital account surplus in balance of payments. The question that arises here, is this capital account surplus good, and is this capital account deficit bad for the countries? The answer are somewhat as follows. LDCs are net borrowers of foreign capital and receipts of foreign investment, and to that extent they would enjoy favorable balance of payment trends. This is undoubtedly true. But sooner or later, this foreign capital and investment will leave the LDCs and go back. Whether they do not go back to their home country, what is most certainly true is that the returns on that capital and investment in the form of profits, interest, dividends and royalties would be repatriated from the host countries to the home countries. In this case, from LDCs to DCs. And this sum would create deficit tendencies in the current account of balance of payments of the LDCs concerned. Autonomous and accommodating transaction. Autonomous transactions are those that take place regardless of the size of other items in the balance of payments. For example, the export of goods to a foreign buyer is an initiating or autonomous transaction, and its value results in a payment by foreigners to the home country, which is entered as a credit items. When the country borrows $500 million from the World Bank to construct dams, then the sum of $500 million will be credited into long-term capital account of the home country. Or if India receives $100 million from the US as aid or vaccination program, then $100 million will be entered as credit into unilateral transfer balance of payment account. All the transactions which take place either in the goods account or the service account or the unilateral transfer account or the long-term or short-term capital account of a country are considered as autonomous or above the line transactions. They arise out of autonomous economic activity. On the other hand, accommodating or below the line transactions take place on account of balance of payment situation of the country. They are the results of balance of payment whereas autonomous transactions are the cause of balance of payment situation. For example, the gold exports of $400 million as a commodity exports proceeds are entered as credit in the country's account. Here gold is exported as an autonomous activity or as current account transaction. This activity causes foreign exchange earnings and thereby determines the balance of payment situation of the country. If India, which is not a gold exporting country, is forced to export gold worth $400 million to settle its balance of payment deficit, then we say that this gold export is not an autonomous but an accommodated transaction undertaken exclusively with a view to solve its balance of payment problems. Here, the gold export is the result of the balance of payment situation and not its cause. This accommodating gold export transaction is entered into India's balance of payment international liquidity account as a credit item. In brief, all credit and debit entries in the balance of payment current and capital account are regarded as autonomous transactions, and all the debit and credit entries in the international liquidity account are to be regarded as accommodating or below the line transactions. The distinction between autonomous and accommodating transactions lies in the question whether the transactions have caused the balance of payment situation or whether the transactions have been caused by the balance of payment situation. It should be remembered that the balance in balance of payments is different from equilibrium in the balance of payment of the country. Strictly speaking, balance is an accounting balance and it must be there all the time for any country. Equilibrium, on the other hand, can be there only when autonomous credit receipt equal autonomous debit payments. Equilibrium is an economically meaningful concept, whereas balance is only an accounting or a bookkeeping term. In common parlance, the word balance of payment balance is used interchangeably with the term balance of payment equilibrium. But the difference between the two terms must be borne in mind. Balance of payment settlement and adjustment. A distinction is made between balance of payment settlement and balance of payment adjustment. Suppose we have a deficit in the current account and capital account of our country's balance of payment. Then we can settle this deficit arising out of imbalances in the autonomous transaction by accommodating payments so as to produce a balance of payment balance in the accounting sense. In this case, therefore, we have undertaken is a process of balance of payment settlement. We have in this case merely and temporarily overcome the balance of payment problem with the help of necessary accommodating transactions. If on the other hand, we control the deficit by controlling the forces which have caused this deficit, then we have undertaken what may be called the balance of payment adjustments. Balance of payment adjustments is said to be taken place only when we have produced balance in autonomous transactions, that is, when autonomous receipts are equal to autonomous debit payments. In brief, when accounting balance is produced with the help of accommodating transactions, this is said to be balance of payment settlement. When this balance is produced without the help of accommodating transaction, this is said to be balance of payment adjustments. Adjustment is more desirable and more difficult than settlement. Now we shall understand the measures to correct disequilibrium in balance of payments. There are various measures which can be used to correct balance of payment disequilibrium depending upon the nature of the disequilibrium. These measures may be automatic as well as deliberate. Further, deliberate measures are in form of monetary, non-monetary or fiscal measures and other measures. Other measures include political, social and international measures. Automatic measures. Automatic measures imply free interaction of market forces of demand and supply. For example, if there is deficit in balance of payment, it will lead to an increase in the demand for foreign exchange. This increase in turn will result in increase in foreign exchange rate and decrease the value of domestic currency. The depreciation of currency will make exports cheaper and imports dearer. This mechanism will vanish disequilibrium and restore equilibrium in balance of payments. Deliberate measures. Deliberate measures are of long run in nature. These can be categorized into the monetary measures. The monetary measures include deflation. It means a decrease in price level and it can be caused reducing the money supply in the economy. There are various ways to decrease the money supply. These include tight bank rate policy, purchasing of government securities in open market, etc. Reduced money supply decreases purchasing power of the people and in turn effective demand. A reduction in effective demand will lead to fall in imports. And as we know, a country faces deficit when its imports exceed exports. A fall in imports will restore equilibrium. Devaluation. Devaluation means reducing the value of domestic currency deliberately by monetary authorities in the terms of another country's currency. Effect of devaluation is same as it is in case of depreciation. That is, imports fall as they become costlier and export increase as they become cheaper after devaluation. The only difference is that depreciation is done by the market forces and the devaluation is brought by the monetary authorities deliberately. Exchange rate policy. The impact of this measure depends on the fact whether country is adopting fixed exchange rate policy or flexible exchange rate policy, because it is not suitable for a country having fixed exchange rate system. Generally, exchange rate is depreciated to bring equilibrium in times of deficit in balance of payments. Exchange depreciation encourages exports and discourages imports, although it has adverse impact on the economy also. For example, exchange depreciation increases the prices of imports and reduces the prices of exports. Hence, terms of trade will turn unfavorable for the country adopting it. Exchange rate policy also includes regulations regarding conversion of domestic currency against foreign currency. More liberal the policy of convertibility of currency, more will be the favorable impact on balance of payment equilibrium. For example, a higher degree of free convertibility of local currency into foreign currency will positively affect exporters and exports will increase. This will help in correcting balance of payment equilibrium. Fiscal measures. These measures include export promotion and import substitution measures. Export promotion measures. The government encourages those industries which are producing exportable goods and services by giving them various facilities and incentives. These facilities are in form of cheap credit facility as well as subsidies. Import substitution measures. These measures include these aspects. These can be tariff. Tariffs are the duties which are levied on the imports. The purpose of imposing tariffs is to curtail imports as prices of imports increase on account of tariffs. Increased prices of imports reduce their demand. On the other hand, domestic producers get induced to produce import substitutes. Then there are quotas. A quota means fixing the upper limit to the quantity of imported items during a certain time period. The government may fix maximum quantity as well as value of a commodity to be imported. The quota system reduces imports and as a result deficit in balance of payments. Then there are various concessions. The government can provide some concessions to the industries producing import substituting goods. These concessions include tax concessions, technical assistance, subsidies, etc. Other measures. There are following other measures to correct disequilibrium of balance of payments. These measures are also known as non-economic measures to correct the balance of payments. These include the political measures. There are several political factors that they may correct the disequilibrium in balance of payments. These factors are to take independent decisions by a check on political alliances, to save foreign exchange by a check on political and administrative expenses, and change in basic political ideology through socialistic pattern to globalized economy. Then there are social measures. These measures include change in consumption patterns, taste and preferences, fashion and trends, etc. in the direction of social awareness. These factors may affect imports and exports of the country. For example, in India, spread of Swadeshi movement went a long way to reduce imports and correcting the balance of payments during British rule in India. Today, import of petroleum product is the major cause of adverse balance of payments. international measures. These measures include new regional, market and international organizations such as WTO, IMF, SAARC, EU, EEC, NAM, UNCTAD, ASEAN, etc. These organizations can help solve the crisis of the nation. In past, these organizations gave the excellent results to solve the crisis problem. Let us summarize what we have learnt in this module. The system of balance of payment accounting, some of the concepts and terminologies used in the balance of payment expression and the interpretation of the balance of payment categories are of utmost importance to the students of international economics. There are various measures which can be used to correct balance of payment equilibrium depending upon the nature of the disequilibrium. These measures may be automatic as well as deliberate. Further, deliberate measures are in form of monetary, non-monetary or fiscal measures and other measures. Other measures include political, social and the international measures.